Hi, this is Kurt Kringles, Head of Credit Strategy for Voya Investment Management. I would like to take a few minutes to share with you a brief update on the performance of the fixed income markets. June proved to be a difficult month for the fixed income markets, with all of the fixed income sectors delivering negative excess returns. The highest risk sectors generally delivered the weakest excess returns. The month started off with stability, but cascading concerns pushed excess returns solidly into negative territory. Positive U.S. economic data contributed to sharply higher interest rates, which was followed by concerns over financial stability in Greece, and finally by concerns over economic weakness and equity market volatility in China. Within the U.S. investment-grade corporate market, the commodity-oriented industries delivered the weakest excess returns, while the more defensively oriented industries generally outperformed, although the pattern was not completely consistent on this basis. Despite the move higher in interest rates, excess return performance within the corporate market had more of a risk-off flavor than an anti-duration flavor. Higher spread industries generally performed the worst, while there was no clear industry performance pattern based on duration. On a year-to-date basis, the energy industry continues to hold on to its excess return performance lead, but the commodity industries are showing some signs of vulnerability. Due to the recent corporate market weakness, the energy industry is now the only industry with positive year-to-date excess returns. Relatively stable energy prices during the past few months have helped support the energy industry. In contrast, the basic industry has lost notable ground as concerns surrounding the Chinese economy have grown. The technology industry has gained the most ground in terms of relative performance, probably due to its more defensive nature during this period of market weakness. Despite renewed concerns about a possible Greek exit from the euro, the financial industry has exhibited far more resiliency than during prior periods of crisis, providing some evidence of success by European leaders in limiting fears of contagion. At any point in time, corporate spreads reflect an array of factors with varying influences. Factors that we have discussed so far this year include commodity prices, new issue supply, and treasury yields. While economists have generally maintained a positive outlook for the U.S. economy, the improving growth expectations have not been enough to push corporate spreads tighter. One reason for this relates to the influence of weaker impulses from decelerating international growth that have weighed at times on the more cyclically oriented industries and on the international sales of U.S. corporations. Consensus expectations generally call for improving global growth in the second half of 2015. The upcoming second quarter earnings season could serve as a positive catalyst for spreads if sufficient evidence of improving global growth prospects filters through to investors.